Hey guys, what's going on? Welcome back to the channel. In today's video, we're going to be analyzing different down payment options for purchasing a home. This is great for first-time home buyers, but it's also good for other individuals who are just not really sure about how much of a down payment they should be putting down on their home. Now, for this particular one, I'm going to need a little bit of help from my financial calculator, and there is a couple agencies that I want to talk about that you might want to look into, especially if you're a first-time home buyer, that might be able to help you out with your actual down payment. All right, so take notes of that. If you don't know who I am, my name is Zevi. I'm the owner of a company called Lonebrook in Los Angeles, California. So with that, let's get started, all right? So how much of a down payment should I be putting when I'm purchasing my first property or a property? Let's start with an agency called Calhafa. And what I'll do is I'll put a link to this in the description of this video, but I'll also put up their website here so you could take a look. Cal and then hfa.com. All right, so www.calhafa, which is hfa.com. And so basically what this agency does is it gives assistance to first-time home buyers, which is defined as somebody who hasn't owned real estate over the past 3 years or has never purchased a home. So what you could do here, and this is not really something that I'm going to dive deep into this in this video, you could check with them and basically decide if this type of a program would be something that fits you, because there are some limitations, I think some income restrictions. Again, I'm no expert at it, but they could help you with the physical down payment, which I think is great. And that's basically as much as I want to discuss down payment assistance, because what I actually want to discuss with you is the analyzing how much of the down payment would be smart to put when you're actually purchasing a property, all right? So what I want to do is I want to create this chart. And the reason I'm doing this is because you could actually, without having to go FHA, meaning that you basically just stay within traditional agency financing, and let me touch on that for a second. You could get a 3.5% down payment loan through FHA, which used to be the only way you could finance a property with a very minimal down payment. So people would still call me and say, hey Zevi, would it be a good idea for me to go FHA? The problem with FHA is that there are other things involved with most people don't know about. They actually require you to put in 1.75% into a pool, and it's called upfront mortgage insurance. Now, I don't want to get too deep into that conversation, because the takeaway is that you could actually get a 3.5% down payment in today's market by either utilizing Fannie Mae or Freddie Mac, which is basically national agencies that no matter where you are in the country, and whether you're getting a loan through a wholesale lender like myself or a retail level bank, they basically sell their loans to those agencies. So those programs are readily available. All right, so just putting that into the universe. Now, when you do in fact get a loan, and as a first time, I'm just gonna say first time buyer, and this is just, I'm just gonna say buyer here, all right? And so the reason I'm doing this is because most people think, what is my big benefit as a first-time home buyer? Well, you could put down as little as 3.5% for a first-time home buyer, right? So that means that if I did that, I would actually be financing 96.5% of my loan, all right? So, so that sounds great. I don't need to come up with a lot of down payment. As a matter of fact, there's something else you could do. You could, depending on, again, don't want to get too complicated, but depending on how much you buy your property for, if you think it's worth more, as an example, say you and I negotiated, I'm the buyer and you're the seller, and I'm trying to buy your property for $300,000, and your property might be worth 310, 315, maybe 320,000, and you know this, but you agreed to sell me the property for 300,000. What I could come back to you and say is like, listen, we've agreed on 300, I'm perfect with that, but let's bump up the price to 310,000, and then you credit me $10,000 or $15,000 towards my closing costs. And the reason I say that is there's two reasons why I'm saying that. Number one is I know your property is worth 315 or 320. So when we request an appraiser to come out and appraise your property, it's more than likely going to appraise. We're not going to have an appraisal issue. All right, so that's one thing. And you want to do this typically before you go into contract and open escrow, because you want to present the contract price as the higher price with a credit to the borrower. And why am I doing this? Because if we agreed on 300 and then you tell me, all right, Zevi, I'll sell it to you for 310 and then I'll credit you back 10,000, that means that if my closing costs, typically 2 to 3%, $6,000 to $9,000, you just covered all my closing costs, which means I don't need to come up with closing costs out of pocket. I just need to come up with that 3.5% down payment. That's huge for a lot of people that don't have a lot of reserves and they still want to be able to purchase a property. So keep that in your back pocket. The only downfall about that is that your property taxes are based on 1.25% of whatever the purchase price is. That's going to be the assessed value. So instead of buying for 300 and paying property taxes on 300, you're going to pay property taxes on 310,000. That's the only drawback. All right. So now going back to this, assuming that somebody buys and finances 96.5% versus somebody who puts down a 20% down payment and finances 80%. What is the difference? The difference is that you're going to have to pay mortgage insurance. And mortgage insurance is typically calculated at approximately 0.5%. Now, mind you, it could be less than that. It could be 0.25%. But it's kind of like insuring anything else. You know, if I insure my home for 100,000, it's going to cost me less than if I insure it for 300,000. So, mind you, anything that is more than 80%, or I apologize, less than 80%, I guess it could go both ways. Because if you're putting down 20%, right, then you're not going to have mortgage insurance. If you put down less than 20%, then you will have mortgage insurance. And the question is, how much, right? So in this case, by putting down the 3.5% down, you actually are paying on the maximum amount, which is basically 16.5% on this piece of the down payment that you didn't put down. You're actually paying mortgage insurance of a rate of right around 0.5%. Now, once this drops down to let's say 10%, meaning that you put down 10% and you're financing 90% of the purchase versus financing 96.5% of the purchase, then your mortgage insurance, this piece right here, I'm going to call it MI, mortgage insurance, would also get reduced. So my point in this video is that even though the big benefit of being a buyer is being able to put down a lesser down payment, or first-time home buyer, because if you're not a first-time home buyer, you could put down 5% instead of you could put down 5% instead of putting down 3.5%. That would be the change between just somebody who wants to come into the market and buy on an agency level, not on an FHA level, versus somebody who's never owned the property or hasn't owned real estate in the past 3 years. All right. So now let's see how this translates into numbers, which I think is also really important. All right. So now let's say that we're buying a property for, and right here I'm going to say, 96.5, and right here I'm going to say 80%. All right. So let's say, again, I'm going to use a calculator for this. Let's assume over here that we're buying a property for $300,000, all right? And let's assume that we are financing we are going to finance 96.5. That means that our loan amount, 289,500. All right, this is going to be our loan amount. And then over here, 300 times 0.8, that's going to be 240,000. Okay, so this is our loan, and this is our loan. Now, this the fact that we have mortgage insurance here, all right, and that's going to be based on 289,500 times 0.5% divided by 12 is going to be a payment of $120. Oops. $120 for mortgage insurance that we're going to have over here, and we're not going to have over here. And we're going to call this MI, mortgage insurance. All right. Now, considering that in today's world, we are in the 7% range hovering, right? Let's take a look and see real quickly what the mortgage payment might be. And I want to go somewhere with this real quick. So let's see, 289,500 at 7%. And by the way, I'll put a link in the description for you that you could do the exact same thing I'm doing, because I'm using a mortgage calculator, which is on my website, which is loanbrook.com, www.loanbrook.com. On top, it says calculators. If you click on it, just click on the mortgage calculator and you'll get the payments, doing exactly the same thing. So plugging in 289,500 at 7% rate, it's giving me a payment of $1,926.05. All right? And basically what I did was here to get the mortgage insurance, I just multiplied my loan amount by 0.5% and I divided it by 12. So that's the monthly payment. All right? Over here, where we have 240,000 at 7%, the payment is 1,596.73. All right? So that's the PI. It's the principal and the interest payments. The same thing is here. So now, two other things we have to factor in, which are going to be your property taxes. Now, I'm in Los Angeles, so if I bought a property for $300,000, I would have to calculate 1.25%, because that's the tax rate, which would actually be $312.50. This would be the tax, and it would be exactly the same thing over here. And then lastly, depending on how much money you're financing, if I was financing $240,000 times 0.3% divided by 12, 0.3%, that'd be the insurance, all right? So that's $60 a month for insurance. And then over here it would be different because I'm financing a higher loan amount, 289,500 times 0.3% divided by 12 equals, this would be basically 72, let's just say 73 for insurance. All right. Now there is one other piece to this puzzle, and that is homeowner association. Now I'm going to assume for a second, you know what? let's add in a homeowner association as well. Let's make it, let's go crazy. So let's say you bought this condo, and most homeowner associations in today's market they're not going to be less than $300. Okay, so let's say HOA, and let's say $300 HOA. Yeah, let's do that, all right? So now, the reason I'm doing this is I'm gonna add up these numbers real quick. 1926.05 plus 120 plus 312.50 plus 73 plus 300. All right, I got a total housing expense here of $2,700. I'm gonna round up 32, and over here I have a housing expense over here I have a housing expense of $2,270. All right, so I'm financing a little bit more here. I have a mortgage insurance payment of $120 that I don't have over here. And the difference in the payments is right around $330 for putting in an extra 16%. But you'll see why I'm doing this. Because typically speaking, all right, if I divide both of these guys by 45%, which is the qualifying ratio, and assuming I have no other liabilities on my credit report, meaning I owe nothing to nobody, then that means 2,732 divided by 45%, okay? That means this person over here needs to make $6,071 a month to qualify. And this person, 2270 divided by 45%, needs to make $5,044 to qualify. And this right here is income. Okay? So realistically, when you go heavy on the down payment, then it becomes a lot harder to qualify. All right, there's about about $1,000 difference here in income. And I got to tell you, over here, you're going to end up paying a lot more interest to the bank versus here. Not only are you going to save $120 a month, basically, which is about $1,440 a year. In addition to it, you're going to pay a lot more interest because your loan amount is slightly bigger. But the idea of being able to cover your closing costs would actually work in either one of these situations. All right, either one of these situations. And me personally, if I was put in a position where I'm a first-time home buyer and I'm trying to decide what would be the right amount of down payment, I would say, and this is basically my point of this video, is that most people think that it is such a privilege and honor for me to be able to put down 3.5% as a first-time home buyer. And I agree, if no other option exists, then sure, put down 3.5%. But if you can get as close as you can to 80% financed, right? Meaning you put down 20%, okay? Because right here you put down 3.5%. Here you put down 20%. My point of this video, the takeaway is that put as much down as you possibly can to make it 20% down versus 3.5% down, even if you're a first-time home buyer. And the beautiful thing about being an owner-occupied transaction is that you can actually incorporate gift funds. So if there's anybody in the family that wants to give you a gift for your down payment because they love you, that's the way to go. All right, guys? Hopefully this was educational. If it was, please drop me a comment. Let me know what you've learned. If you have questions, please put it in the comments as well. I look forward to reading them. If you've enjoyed this video, please give it a thumbs up. And if you need any type of assistance in getting pre-qualified and running this scenario for yourself, I'm completely available to do that for you. My number is 818-697-8220. I will also put that information in the description below. Otherwise, I appreciate you. If you want to see more content like this, please remember to subscribe to my channel, and I look forward to seeing you again on my next video. Take care.